What's up, guys? It's Ron from Ron Roy Law, and in this video we're going to talk about choosing your market. Now, I posted about this topic a few years ago, but it recently came to my attention that new investors, they're starting off, and even new experienced investors, they're saying things about your market that don't really produce successful results. So watch this video if you're interested in defining your market, and if you're starting off and wondering, where should I invest? This is the video for you. Ron from Ron Roy Law, and if you follow this channel, welcome back. If you're new, this is an industrial investment channel. We focus on industrial real estate, but we help people in retail and multifamily as well. So this question is about, what is my market? And I was kind of prompted to do this video. There was a recent Reddit post. Somebody says he has $5 million to invest. He's based in New York City, and that's an area that he likes. He's comfortable with it, and even at that price point, he can afford it. But when he asked about his industrial market, this guy was saying New York, New Jersey. He was looking at Pennsylvania. He was looking all the way down the Atlantic to possibly Northern Virginia and Maryland areas. It was insane. And I think a beginning investor, you really have this natural inclination, which is you think, I don't want to shut off too many areas. I want to be open. I want to help myself by, if a good deal comes up in Pennsylvania, why wouldn't I be open to it? And the reality is that in real estate investing, it's actually the opposite. When you have such a broad area of possible places to invest in, for example, my New York, New Jersey, let's say you're looking at small industrial deals, $5-6 million a pop. If you list all of that area, there's probably 140 different sites that could meet your criteria. Billions of dollars worth of real estate that is just, it's too much volume, it's too much market area to look at. And if you are going to be successful, you really have to narrow your focus, and you need to look at a very small slice of the commercial real estate pie in order to understand where you are willing to invest. Because the more you can concentrate your search and the more knowledge and expertise that you have on a specific market, it's going to produce more results. So just as a small example, if you say that you want to invest in the northern part of Dallas County in flex, shallow bay, whatever, Class B industrial, you are still going to be looking at hundreds of buildings that fit your criteria. At any given time, a couple of those are for sale, but more importantly, when you network with brokers, when you talk to attorneys, when you talk to other investors in that market, they will know exactly what your buy box is, and that is much more important than being willing to buy a deal in a neighboring county, being willing to buy something in an adjacent city. None of that matters, but you need people to know exactly what you'll buy, as well as giving yourself the confidence to actually buy a deal because you're the expert in this very small sub-market. While I talk about industrial, this is absolutely true for multifamily, it's true for retail. The only difference I would say is that, multifamily maybe has a little bit less variation between the competing product types. So your area might expand depending on how many properties actually fit your criteria in that box. And so if you're an investor in New York City and you're willing to be open to the type of markets and the price points for New York, New Jersey, kind of those port inland areas, I think even within that, you have to really figure out where is your best market and what is your ideal market, and then really exclude everyone else. Because the amount of time and energy that it takes to fully investigate and immerse yourself to be an expert in, just say, Northern New Jersey port industrial properties, that's all you need. And especially if you're only deploying $5 million, if you're looking at smaller deals, it is too distracting to also be underwriting and looking at deals that are located in Philadelphia, looking in Queens, New York. That's too much of a variation. And I think it's true for retail, it's true for multifamily. What you do is you decide on a small market first, and only if you reach a point where you've surveyed every single property that fits your needs in that certain submarket. So let's say I'm buying multifamily in north of Austin, suburbs area. If you've surveyed every single multifamily that fits your criteria, let's say there's 30 or 50, none of them are for sale. You've already reached out to all the brokers, all of the property owners, all the property management companies. Nobody's selling. That's okay. At that point, I would tell you that you could expand your market, but this process might take 3 months. It might take 6 months without getting any type of seller interest in a deal. At that point, you could identify and you can move on to something similar. But there's a key difference here. You don't want to start wide. You want to start small and then expand like a copy and paste type of format, as opposed to casting a wide net and thinking that you're going to find a good deal that way. And so again, I'm coming from a place, I've been a lawyer for 15 years. I have witnessed my investor clients searching for a year for their first property and being unsuccessful. The best investors start with a very, very small buy box. And for retail, that might be non-grocer anchored single building strip malls without a drive-through. That is a very specific product type. You're going to naturally have square footage parameters that are pretty consistent. And ultimately, you're going to build relationships with the people in the market just by virtue of talking to them, asking them how the market is going. And for that type of strip center, you might be open to all of southern Collin County. And for people that don't know, Collin County is immediately north of Dallas County. It includes Plano, Frisco, Allen, McKinney to some parts. And it's still a huge area. But what you would do is figure out the vintage. And I think that you could survey properties for large parts of a county, but you might put a big factor of nothing older than 2000 construction, or only products that were built after 2010, just as an example. And so defining your market is not just geographic. And I think people also tend to really focus on the geography, the physical proximity, which is important, but sometimes by age or by style of construction, that might be more impactful for dividing up the available existing properties. If you're a new beginner, it's absolutely critical to start with what are your strengths. And I don't mean this in like a very hypothetical sense, but what are your strengths in commercial real estate relative to other investors? And you have to have something, because commercial real estate is a very competitive world. There are a lot of big players with a lot of money, people who know what they're doing. And you have to understand what you can do better than anybody else in your market. And it's okay. You know, I think just having local knowledge, physical proximity, or willing to take certain risks, those can be your strengths, but you should identify them. And once you identify your strengths, that will naturally lead to a market or a product type that is going to be suited to your strengths. And again, for example, if you're a smaller investor, that's okay. You have more ability to invest in smaller buildings, smaller tenants. You're closer to these types of issues, and you're willing to do more work for arguably a smaller absolute return than even some big investors. I won't buy a deal smaller than 4 acres, for example, but that can be somebody else's strength, because as people grow, the juice isn't necessarily worth the squeeze on a smaller deal. That can be your window of opportunity. And once you define your market, it's not necessarily that it becomes static forever and can never change. Take myself, for example. I learned through feedback from talking to other brokers and different sellers in the marketplace that I needed to specify no automotive uses. And what that means is, while I like truck parking, we're not performing automotive services. And there's a big difference on the risk, on the environmental concern, as well as just having a multi-tenant property running auto uses. So in general, automotive users, they tend to use a ton of parking. They have junked or broken vehicles that can leak fluids, and they have inoperative vehicles that the cities also hate. They're going to make you put up a lot of fencing, a lot of opaque barriers. And so a lot of investors shy away from automotive users because of the chemicals, if they're paint, if they're using solvents. And so for that reason, I was getting a lot of deals that had auto uses and I didn't like them. And so I had to tweak my buy box a bit to reject the auto users. And you're not going to get that knowledge until you get out in the market. And I think, again, it's a minor tweak, but it helps me eliminate some of the deal flow that I was automatically rejecting. So in conclusion, I really want to nail this point home. Starting with a small market allows you to have two major advantages. You have confidence and you have speed of execution. You really have knowledge that this is a good deal. Everybody in that market presumably knows who you are. They're going to give you deals that are in your buy box that you're likely to close. But especially when you're starting out, confidence cannot be overstated because you're concerned and you're cautious, and understandably. But if you know every single building, if you know every single tenant who is looking for space in that area, if you know what people are leasing their space at, that is going to give you confidence, and that is going to be conveyed to your lenders. That's going to be conveyed to your investors. But it's absolutely critical to start with a small market area buy box for those two main reasons. All right, well, that wraps up this video. It's kind of morphed from the knowing your market to the buy box, but that's okay. I think these terms all kind of blur together, and at the end of the day, you need to develop a system that works for you. This is just what I've done and works for me. So smash that like button if you're still watching, and subscribe if you like the content.